Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at CMCT.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. The big story here is this major strategic pivot.
Right. It feels like they're trading one whole business line just for the liquidity to fund another one.
That's it, exactly. And the most immediate, the most positive catalyst is the sale of their lending division.
To PGFR Holding. That deal is valued around $44 million.
It is, but the number you really need to focus on is the net cash they'll get, about $31 million.
And the critical part, the why, is that those $31 million are specifically for their multifamily real estate expansion.
Precisely. It's a calculated move. They're cleaning up the balance sheet and focusing all their firepower on their strongest assets, especially in those high barrier markets.
Okay, so that's the plan. But let's look at the current reality. The most recent fundamentals from Q3 2025, they show some of the pain points they're trying to move away from.
Oh, for sure. The pain is definitely there. You've got a net loss of, what, 17.7 million?
Yeah, and funds from operations, the FFO, was negative 11.1 million. That was mostly driven by disruptions in the hotel segment.
And this is the interesting part. Those losses are actually getting smaller.
Right. That's what I wanted to point out. It suggests that some of the strategic shifts were maybe already starting to take hold even before this big sale.
Exactly. And the real strength, the resilience, is in their leasing and multifamily parts of the business.
Their multifamily net operating income, or NOI, actually grew.
And that was because of better occupancy and, crucially, rent increases in San Francisco.
So they have pricing power in these key markets.
They do. And office leasing showed real strength, too. They secured almost 81,000 square feet in Q3.
And to put that into perspective for you, the year-to-date leasing is up about 55% year over year. That's around 140,000 square feet total.
Which is huge. And while the overall portfolio occupancy is, 73.6%.
It jumps to 86.6% if you exclude one specific asset that's dragging it down.
Right. So the good assets are performing very well. It's a few bad apples spoiling the average.
That brings us to the elephant in the room, though, the debt.
Yeah.
How do they manage all this with long-term debt over $512 million?
That's the core bear argument, no question. It gives them a really high debt-to-equity ratio of 1.79.
Which is a big risk. But they have been proactive about it.
They have. They recently refinanced a big $81 million mortgage, extending it out to January 2027.
And they paid down $6 million of the principal right away. They also refinanced a $35.5 million mortgage in Austin.
And those moves are smart because they reduce their recourse debt exposure, which is key to protecting the rest of the portfolio.
So they're buying time, but liquidity is still a concern, even with the $31 million in cash coming.
It is. You get these mixed signals. Their current ratio looks okay. It's at 2.1, so that suggests short-term stability.
But the quick ratio is where the red flag is. It's at 0.5.
And for you listening, the quick ratio only looks at assets that can be turned into cash almost immediately. A 0.5 ratio means they can only cover about half of their short-term liabilities quickly.
That's a tight spot to be in. Plus, their operating cash flow was negative last quarter.
Right, at minus 2.48 million. So that 31 million isn't just nice to have, it's survival capital to execute this plan.
So with that tight balance sheet, why would anyone invest? It has to come down to the quality of what they own.
It's all about the portfolio quality and location. They own 27 urban assets office, multifamily development sites, and one hotel.
And their focus is on those really high barrier to entry markets. We're talking Los Angeles, San Francisco, and Austin.
Exactly. And they specialize in what they call creative office spaces.
Which basically means premium community integrated properties, not just generic office towers.
Right. They're designed for high-growth firms, and that's what drives their leasing momentum.
A great example is that 31,000 square foot lease they got with a global medtech company.
That's the perfect example of the strategy working. It shows there's demand for their very specific, curated niche, even when the broader office market is weak. It's a huge competitive edge.
Okay, let's pivot to the technicals because the stock price action has been wild.
Wild is the right word, almost meme-like volatility. We saw surges of 32%, 58%, even 69% on the day the sale was announced.
The stock closed at $8.21 from about $5 just one day. The high was almost $10.
That kind of move confirms there's significant accumulation going on, and it's often fueled by a short squeeze.
Absolutely. Analysts are seeing this as a major breakout above the old resistance level, which was down around $3.49.
And from a technical view right now, the support seems to be forming around that $5 mark.
So that could be seen as a key entry point for anyone betting on this pivot working out.
I think so. The market sentiment is sort of mixed to bullish, but it's heavily, heavily influenced by the sale that shores up the balance sheet.
So what's coming up? What are the near-term catalysts we should be watching?
Two big ones. First, the final closing of that $44 million sale. It's still pending SBA approval, so that has to happen.
And without that, the $31 million in cash doesn't arrive.
Exactly. And second is the Q4 2025 earnings report. That's expected in early February 2026.
We also have a leadership refresh with the new CFO, Brandon Hill, that signals management is all in on the new strategy.
And you have macro factors, too. If interest rates get cut, that's generally good for REITs. Plus, there's a broader sector rotation happening that favors multifamily assets.
Okay, but let's not forget the bear case. We covered the high leverage. What's the biggest execution risk here?
The risk is simple. Can they convert that $31 million into successful, cash-flowing multifamily projects before the debt becomes a problem?
Right. And they have to do that while still managing the drag from their hotel and some of the legacy office assets?
Plus, the stock has a history of volatility and even past reverse splits, which should always make investors cautious.
So let's wrap this up. What's the elevator pitch for CMCT right now?
The pitch is that the $44 million sale provides the funding for their high-quality multifamily expansion, and it reduces the immediate debt pressure.
And the internal numbers are moving in the right direction. Leasing volumes are spiking 55% year over year in their best office spaces.
The whole thing is positioned for a cash flow turnaround in 2026. For an investor, the volatility might create entry points under $5 with an eye on an upside toward 10 or more if they execute perfectly.
So the story of CMCT is really a race between debt management and the successful execution of their strategic pivot into high-growth multifamily markets. It's a high-risk, high-reward play centered on the quality of their real estate holdings.
Indeed. We'll be watching for those Q4 earnings and the official close of that lending sale. If you want to keep up with all the catalysts and market movements we analyze every day, please make sure you subscribe to Smart Wealth with Joshua.